Equity managers aren't beating indexes, but it was intriguing in your report. Bond fund managers seem to be doing a little bit better. So active managers in the intermediate core bond space, sort of the broadest space possible, did well. 84% beat their benchmarks. That was impressive to me, although I see over a 10-year period it slips down to 27%. Why did active bond management do well in the last year, Ben? And then I want to get to Jerome.
Well, it speaks to the fact that active bond fund managers, unlike their stock picking peers, have generally over longer periods of time been able to add an increment of value by making out of benchmark bets. And what we saw in that 1 year look back that you mentioned, Bob, is that the overwhelming majority of active managers in the intermediate core bond Morningstar category beat their average passive peer precisely because they took on more credit risk relative to the average index mutual fund or ETF in their category. So they can color outside the lines in a way that index funds by definition can't. They can be more opportunistic, and they can reap rewards from coloring outside the lines and being more opportunistic, as many did in this most recent episode we saw in the markets.
So, Jerome, is that what you did? Now, you run the PIMCO Enhanced Short Maturity Active ETF. Mint is the symbol. That's, I believe, it's the second biggest actively managed bond ETF in the world. You outperformed as well. What's the difference between active versus passive bond funds? We talked earlier. You were saying there's thousands of stocks you could choose from, but there's millions of bonds to choose from. Does that give you flexibility?
I think the flexibility is important, and you're right to highlight that. ETF isn't spelled PASSIVE any longer. I think that flexibility, especially in bond funds, bond ETFs, allows for not only coloring inside the lines, but also not being forced to color at all. And so I think one of the things that Ben's report highlights is actually really important, that active ETFs actually allow for a degree of flexibility, perhaps taking additional credit risk, but it's also, as the landscape changes, which we are in an age of transformation right now, we need to be able to adapt and not necessarily picking to color outside the lines, but also picking to color maybe a little bit less within the lines, within the index. And that's really what is going to be the deciding factor about thinking about performance, not only the beta, but also the alpha, the ability to differentiate between indexes, and more importantly, the risks that the indexes might pose in the current economic environment. And I think that's one of the critical facets between active equities and active fixed income, which needs to be digested fully by investors. And so as we move to a more expansive universe of fixed income ETFs, that active approach will be an incredibly large differentiator, as been highlighted in his report.
I want to get this point across. Did you take more credit risk than your passive peers? Is that why you outperformed? I mean, just tell us what exactly happened here, because it's not obvious. You can do anything you want. Essentially, you could go to cash. So.
No, I mean, that is fair. But what we seek to do is build a diversified portfolio. And having the resources to run the gamut of different types of asset classes, not just corporate credit, but look at structured products, maybe have a little bit more cash. Think about where an interest rate curve might be more sensitive and be more advantageous to clients. That's really the facet which hasn't been fully optimized or optimized at all within the passive universe of the ETFs for a very long time. And so in the past, while the Fed was in its new normal policy measures, being very vigilant, low volatility, and providing a very balanced view of where credit spreads and risk appetite was, that was fine. You could possibly take more credit risk, whether it's in corporate credit or structured products. But now that we are evolving to this age of transformation, it actually is critically important to create differentiation within the product and not necessarily embed or be wedded to a growing aspect of the beta risk in the index that might actually prove very harmful to investors. And so just one thing to point out, back in 2008, the composition within the Barclays aggregate, the fixed income aggregate index, was about 8% for triple Bs. Now it's north of 15%. So simply by owning the index, you're owning a lot more credit risk, which may not necessarily be the right positioning to have in this current environment where we sit here today with growth moderating and a variety of central bank policies creating the propensity for a little bit more volatility in the future.